everyone, this is Riya Singh, the currency analyst for Nirmal Bank. So let's look at the current factors that have been resulting into the consolidated movement that we are seeing into the Indian rupee. Now, if you look at the underlying economic factors where Indian economic activities have remained stable in the month of March as lifting of most of the COVID measures have boosted demand, keeping the war-induced price pressures from hampering the economic recovery, at least for now. The positive sentiment that is coming into the Indian economy will be able to counter some of the Russia war-induced supply chain disruptions which have elevated the commodity prices. Now, the second positive factor that is working for the Indian economy is the PMI numbers. Now, if you look at the PMI, it is at 52.3, which is above the 50 levels. So this is one of the positive indicator. This is translating that the service sector have recovered quite beautifully, and the industrial sector is also signaling expansions. Now moving on to the other positive factor, if you look at the export numbers, now it has come around 42.2 billion in which is aiding into the trade deficit. Now these positive numbers have come on the back of the petroleum demand that is coming in, as well as the engineering goods demand. So both of these factors are resulting into a good export numbers, which is helping the trade deficit to shorten from 20.9 billion that we saw into the month of Feb to 18.1 billion in the month of March. So the only risk, the upside risk that is there for the Indian economy is the inflation numbers and the resurgence into the COVID numbers. Now we are seeing some resurgence into the COVID numbers, which is limited to the capital of New Delhi. But of course, if the numbers elevate much further than that, there could be a risk of some mild measures that will again come in, thus curbing some of the economic recovery that is happening there. The second is of course the inflation, which is happening due to the elevated commodity prices, but also the most of the numbers being reflected into the consumer end as well, because if you look at the various companies, they have started to translate the elevated commodity prices, the elevated input raw material prices onto the end consumer. So these are the major two factors that could hamper the economic recovery. Now, as far as dollar index and Fed activity goes, now if you look at the Fed, they are on the strong hawkish tone, which is expected to get translated into furthering the dollar index strength. Now, if you look at the economic numbers of the US, the major concern was the employment numbers. The jobless claim in the US is at the lowest. The economic recovery is almost at par before the pandemic came into the before the pandemic started. So both these factors, which was the main concern, which was keeping the Fed from going for a rate hike, have been put onto the side. So this is again fueling into the probability of Fed going for a rate hike of 50 bips evidently into the upcoming Fed meet, which is scheduled at May 2nd and 3rd. So this could again result into some weakness into the Indian rupee, because this will definitely trigger FII outflow, which is already happening. If you look at the March numbers, they have been FII as well as FII funds have been a net seller into the Indian economy. So these are the reason why the Indian rupee has not been able to sustain the appreciative levels of 75 or even of 75.50. So going forward, I think the overall outlook on the Indian rupee will be that it will maintain the range of 77.50, 76 levels taken into concern the liquidity crunch that will come into the US, the Fed going for an aggressive hawkish tone, rate hike of anywhere between 50 bips to 75 bips, and RBI maintaining an accommodative stand. So all these factors will definitely result into the Indian rupee being into the range of 77.50, 76 levels. So that's what the outlook for the Indian rupee is on a shorter term. Thank you for listening.